would like your best advice you would like to give to our audience about growth in companies?
Going slow and getting it right, being a disciplined investor. One of the conversations that I have with clients in that regard, that you really want to have a long-term out. Markets tend to about every 5 to 7 years on average. So if you are in a well-diversified investment portfolio, you're in an active managed strategy, you really want to minimally allow that strategy to be tested through at least an entire market cycle. Because once you get to an entire market cycle, then you can go back and say, over the course of this cycle, how did my investments perform? Am I comfortable with the risk? Am I comfortable with the volatility? And that's coming back to say, where if you're consistently making, an average of 6 to 8% year over year, that is a great builder of overall long-time wealth. Again, as opposed to fantastically and chaotically chasing the market. Cheekily, I always say, it doesn't matter whether you're Warren Buffett or Jimmy Buffett, no one can time the market. It's a losing investment strategy. Set your tolerances, figure out what your actual long-term goals are, what's your time horizon, build your portfolio with that mentality of the future. And that is a great way to build wealth.